Welcome to Off the Clock, a podcast by Procino-Wells and Woodland, where we take a team-centered, family-focused approach to serving the estate planning and elder law needs of our community on the Eastern Shore. I'm Amber Woodland, one of the attorneys at PWW Law, and today I'm super excited to be joined by Jeff Montgomery, president and owner of Montgomery Financial Services. We're going to be talking today about retirement accounts and planning for those, so let's just jump right in.
Sure.
Good morning.
Good morning, Amber. How are you? Thanks for having me.
So well, thanks for being here. We are
Sure.
so super excited. We feel like we have a podcast largely because of your guidance and expertise. So I definitely wanted to start out by just saying you have done an amazing job with the fiscal blueprint, and we hope our
Thank
listeners will listen to you.
Yeah, but you've taken it to a whole nother level here. So,
Well, yeah, the video component can be a little scary,
right,
but
right.
I'm
No,
excited.
this is great.
Yeah.
It's a great setup.
Yeah, awesome. So you have extensive background in financial advising. You work with clients all across the Eastern Shore. Will you just do an introduction for our listeners about even what a retirement account is so that they can relate to what we're talking about today? Because I know you're probably like us. Almost every client we work with has some form of retirement account that they have set up.
Sure. I think when most people think of retirement accounts, they think of your typical 401ks, 403bs, which are, nonprofit retirement accounts, 457bs, and traditional IRAs. They're usually called qualified accounts because they qualify under ERISA, and that's an employer sponsored retirement plan. But there are also non-qualified retirement accounts that kind of act like retirement accounts. And I think most people, when you're thinking about retirement, you're thinking about some type of advantage, right? What's the tax advantage of opening up a retirement account versus just a normal brokerage account? And that is the difference. And that's where retirement accounts really come into play, and because they have some significant tax advantages versus non-retirement accounts.
And yeah, so we see that our clients in their working years have put money aside in qualified retirement plans, and then they reach retirement age and they start looking for advice. I think it's so important, and we believe that our clients need every advisor, including a financial advisor, an attorney, an accountant at the table to make sure that their plan is really going to be carried out the way they want it to.
That's correct. The plan's a lot bigger than just the retirement account, right? There's
Yeah.
a lot of moving parts, and that's where a good tax accountant comes in, a good elder law firm comes in, and a good financial advisor.
Yeah, absolutely.
Yeah,
Yeah.
exactly.
We have clients sometimes who say, "Can you help me with my budget? Can you help me how to invest these assets?" And we say, "No, we don't know anything about that. You need to go to a good
Exactly.
advisor and get good advice. And then as you approach retirement age, how to pull money out of those accounts and how to fund retirement after you're no longer working." So,
Yeah, that's super important. And with the tax aspect, I believe in tax diversification. I believe in having non-retirement accounts.
Sure.
It's liquid. You can get to it. No, very few, if any, penalties to take money out. Having tax deferred accounts, right? This 401ks deferred, you're going to pay taxes later. And having tax-free accounts such as Roth IRAs are also important. So we call that tax diversification in our
Okay.
firm. And I think that's super important. And that gets to the point about, where do you take money out when you no longer working, you no longer have that paycheck coming in?
Right.
Where's the money going to come from? Where's the income going to come from? So that's super, super important.
Awesome. So the primary focus of our episode today is to talk about the Secure Act. It's crazy because January 1st of 2020 is when this went into effect.
Yes.
And this year, I'm sure everyone can relate, has been a complete blur.
I know.
And the poor Secure Act has been a little overshadowed by everything else that's been going on.
It has.
Yeah.
It really has.
So will you just do a brief introduction for our listeners about even what the Secure Act stands for? I think the acronym is kind of funny.
Yeah, so we always talk about the federal government Department of Acronyms
Yep.
came up with the Secure Act, and they worked overtime on this one. So
Yep.
it stands for Setting Every Community Up for Retirement Enhancement.
Yep.
What it stands for. I don't know. I think that's kind of funny. But anyway,
Me too.
it's probably the biggest change to our retirement system in decades. And there are some positive changes with the Secure Act, again, effective January 1st of 2020. And then there's one big negative change that we've talked about with the Secure Act. So it was passed on, I think the president signed it in late December, and it was effective January 1st. But like you said, a lot of people forgot about it because here comes, the coronavirus situation, and
Right.
it kind of got put on the wayside. So
Right.
it is important to understand how it works, though.
It's super important. And then the federal government passed the CARES Act, which we're going to talk about a little bit later, and how that maybe impacted
Yeah.
retirement planning, at least for 2020. So I'll be interested to hear what you have to
And I
say about
get
that.
questions about that, and people get confused about the Secure Act and the CARES Act,
Right.
the different parts of it.
Yeah.
So,
Yeah.
yeah.
So talk just a little bit about the two better
Okay.
parts, okay, of the
Okay.
Secure Act and why we think that those could be beneficial for people approaching
Okay, we'll
retirement
go over the
age.
positives
Yeah.
first. Okay,
Okay.
the first positive is that prior to the Secure Act, if you were over the age of 70 and a half
Mhm.
and you were still working, maybe you wanted to work part time, who knows, maybe you had to work, you could not fund a traditional IRA. You were not allowed. Now, you could always put money into a Roth IRA,
Mhm.
even after age 70 and a half. But you couldn't fund a traditional IRA. And with the passage of the Secure Act, you can now fund a traditional IRA even after the age of 70 and a half, as long as you have earned income.
Mhm.
That's the main thing. You have to have earned income. So you have to be working wages, those kind of things. Not investment income, not passive income, earned income.
So if someone's 80 years old and they're still working because they're setting themselves up for retirement success,
Sure.
then they could technically still contribute.
You can still contribute to a traditional IRA. Now, remember, and we'll get to this in a second, that you also have to take out of your retirement accounts after age 72, and that's one of the changes. So it might be a wash, but still, it's something that you can still do.
Yeah, yeah, that's
Okay.
a neat distinction that I don't think has occurred to me before.
Yeah.
At 72, you still have to take the required minimum distribution, yet you
Right.
could still be
You
contributing
can.
if you still
Right.
have earned income.
Exactly.
Yeah,
Right. Right.
yeah, interesting. So, what about this whole concept of the required beginning date having been 70 and a half, the year in which a person turns 70 and a half, and now it being 72? Will you just elaborate on that just a little bit so our listeners understand really what that means? I mean, folks who have already reached the required beginning date understand, but maybe
Yeah.
those approaching it don't.
Okay. So they changed that as well. So prior to the Secure Act, the year you turned 70 and a half, you had to take out your first required minimum distribution. And the federal government had a uniform life table, and they estimated your life expectancy factor, and they told you how much you had to take out. You had to take it out, or else it was a 50% penalty,
Mhm.
right? 50. They did give you a little grace period till April 1st of the following year after you turn 70 and a half. And that always caused a lot of confusion for people because they didn't know when they turned 70 and a half.
Right.
Um, but they eliminated that if you were 70 and a half after 2020, they moved it to 72. So
Okay.
now remember, if you turned 70 and a half in 2019, you're under the old rules.
Mhm.
But in 2020 now, the new required beginning date is 72. The year you turn 72, you have to take your first minimum distribution out of your IRA account. They do still give you a grace period. You still have until April 1st of the following year
Okay.
after you turn 72 to take out your first one. But we usually don't recommend that because you still have to take out the second one in that same year, and that could bump you up into a higher tax bracket because you're taking out double from your IRA account.
Right. And the reason why that required beginning date is set by the government is because they want to start taxing those
Right.
tax deferred
Right.
savings.
And
And
this is a little tidbit that I think is really interesting. The IRS, or the federal government, let's say, they don't look at your IRA account as an asset.
mm,
They look at it as income. They actually
mhm,
call it income. They call it IRD,
mm,
which is income with respect to the decedent. You call
mhm,
it an asset.
mhm,
They call it income. So
mhm.
they want to get their hands on that tax money.
Right.
And that kind of leads into number three
Yeah.
that we're talking about.
Yeah, I think the biggest change, at least in with the families that we serve and the families that you serve, probably is this idea that we have eliminated the opportunity in most cases for retirement accounts to be stretched after the original account owner's death. So,
Yeah.
talk about how that's already impacted maybe some of the discussions you've had with your clients, and so our listeners really understand how
The
this
difference.
accelerates the taxation of a retirement account.
Yeah, so we went over two positives, right?
Mhm.
The big negative with the Secure Act is it it all but eliminated the stretch IRA.
Hmm.
So prior to the Secure Act, if you left your IRA to a non-spouse beneficiary, that beneficiary could stretch out those payments, those minimum distributions over their life expectancy. So if you were like a 40-year-old,
Hmm.
you had a 43 and a half year life expectancy, according to the IRS.
Hmm.
That's a huge stretch out. That money would still continue to grow as you take out minimum payments. A huge legacy, right? Now, with the new Secure Act, a non-spouse beneficiary, there are some exceptions,
Right.
but a non-spouse beneficiary has to have that account drained within 10 years after the year of the death of the account owner. So they're accelerating the distributions, which means more taxes faster.
Right.
Yeah.
So in your example, we went from over 40 years to pull that money out of the inherited plan to 10
To
years.
10 years, exactly.
Right. And that could easily throw a beneficiary up into a higher tax bracket, causing those distributions to be taxed at higher rates. And
Exactly.
yeah, I think that that relates right back to what you were saying. When you look at the retirement account balance, it's not necessarily what you see on your statement
Right.
because taxes haven't been paid yet.
Exactly.
And the IRS is trying to get their hands on that tax now sooner than they ever have before.
And then also think about it, a lot of times parents will leave an IRA to a child, and maybe it is the child's 40 or 50 years old. They're in their prime earning years.
Right.
They may be being, at the highest salaries that they have. Here comes this IRA account on top of that other income, and that could shoot them up into a much higher tax bracket.
Right. Yeah, so a couple exceptions that you mentioned, with every good general rule, there are always exceptions.
Hmm.
I think the biggest question that's come up for us after the passage of the Secure Act is what about spouses?
Yeah.
What happens if you're married and your primary beneficiary is your spouse? Are they subject to these rules?
They are not. They are not. It's exactly the same as it was before. And as a matter of fact, a spouse can actually treat the IRA, the inherited IRA, as their own.
Hmm.
And they can actually, let's say they're under 72, they can actually treat it as their own and postpone their minimum distributions until they turn age 72.
Right.
So that for a spouse, everything
No
is fine.
change.
And there's a couple other exceptions. A minor child,
Mm.
but it would have to be the account owner's minor child, not just some random
Yeah.
minor child out there. The
And
account
I think
owner's
importantly, not grandchildren.
not grandchildren.
Mhm.
That does not count.
Mhm.
Also, if you're within 10 years
Mhm.
of age, if you're 10 years or less younger than the
Mhm.
account owner, so
Mhm.
maybe a friend, you leave
Mhm.
your IRA to a friend,
Mhm.
or maybe a sibling,
Mhm. Mhm.
within that 10-year period, they can still stretch it out among their life expectancy.
Okay,
Yeah.
gotcha. We're not going to get into it too much, but the other exception we sometimes see is when there's a disabled beneficiary. So that is so important if a person is planning and they have a loved one who is disabled, that they plan for every asset, not just the retirement plan. We use different
Yes.
types of trust and things like that. But so I had a meeting with a client a couple months back who has substantial savings and retirement plans, had originally planned for those assets to go funnel through a trust at his
Hmm.
death. And we had to have a conversation now after passage of the Secure Act about how that's different and how maybe we should restructure the plan. So I want to talk a little bit about planning strategies
Okay.
that have come up as a result of the passage of the Secure Act. So I think one of the easiest things to consider is retirement accounts name individual beneficiaries. They typically name in a married couple the spouse and then maybe the children or the grandchildren. So accepting the 10-year payout requirement is just something people are going to have
Sure.
to do.
I
And
hear
a
it all the
lot
time.
of people are going to just do that. But I think to your point about the children could possibly be in the highest tax bracket
Hmm.
at the time that they receive the IRA balance, maybe it's an opportunity to leave it to the next generation.
Skip a generation.
Still
Yeah.
subject to the 10-year
Yeah.
rule,
Yeah.
but in a lower tax bracket.
Correct.
So, are you
Correct.
seeing that?
I don't see that too often. There's a couple other things that we see. I mean, that's definitely something you can do. Accept it. I see accepting the 10-year.
Yeah.
I hear it
Yeah.
all the time. Hey, they're going to get the money. I'm going to be gone.
Right.
I'm okay with it.
Right.
So I
Yeah.
hear that all the time. But I don't see the second one where they skip a generation. Usually, I see it. They're leaving it to the primary beneficiary, which is their spouse,
Mhm.
and then they'll have contingent beneficiaries, which are the kids.
So, what if they are charitably inclined? Could a client who has qualified retirement plans leave a charity as a beneficiary? And is that subject to the rules of the Secure Act?
Yeah, that's something where you are probably going to come into play quite a bit with charitable remainder trust.
Mm.
I can see that for especially if there is a account owner that is charitably inclined, right? They
Right.
want to leave a legacy to their kids. They want the kids to stretch it out as much as possible, but also leave something for a charity. So I can definitely see a charitable remainder trust, a CRT,
Mhm.
playing into that planning for those type of folks that are inclined to give something to charity.
I'm thinking about clients I have, married couple, but they have no children, and they are very charitably inclined. And in our design meeting, we actually drew a line on the piece of paper. We put their non-retirement accounts on the left side, and we put their retirement plans on the right side. And we said, let's leave your retirement plans to your charities, because if we do that, they're not going to pay taxes on that money.
Correct.
And then we'll leave all of your non-retirement plans to your individual siblings, nieces, nephews, all the other individuals in your family. So I think that creates, for the right family, a really cool planning
Sure.
opportunity. We could leverage the retirement plans by leaving those to charity for
I
someone who's
think
charitably
I think
inclined.
that's a great idea.
Yeah, so that's been a neat difference, I think,
Okay.
that maybe we now realize this money is going to be taxed. We've always known if we leave it to charity, it's not taxed, but now even more so under the Secure Act, it creates a great opportunity
I
to
agree.
eliminate the
That's a
taxes.
great plan.
Yeah. So, uh, using trust, I do want to talk about just briefly, because that's something kind of on our end that
Right.
we create retirement account trust when it's the right fit. So sometimes listeners or prospective clients think that they have to have it all figured out before they walk into our offices. Well, that's our job. And it's our job to figure out, is a trust to receive a retirement account the right fit
Right.
upon their deaths? And sometimes it is. And that's because maybe their beneficiaries have risks,
Sure.
subject to divorce or bankruptcy, dependent on government benefits, have large creditors. We sometimes use trust as beneficiaries on IRAs, even if it means paying more
Pay more
taxes.
taxes.
Yeah.
Exactly. Right.
So I think the message that I want to send in talking about this topic is there's no one size fits all plan.
That's true.
It is very unique under every
Very individual.
family's different circumstances.
Exactly.
One of the things I'm super excited for you to talk about are the potential benefits of doing Roth conversions under
Okay.
the Secure Act, because I have identified on a number of occasions families who've come into the office. They have large pre-tax retirement accounts. Their kids are in high tax brackets, and what a Roth conversion might look like for them under the Secure
Under the
Act.
Secure Act. Yeah. It's going to be a planning strategy. I think you're going to see a lot, especially with our tax code, which is set to expire in 2025 and go back to the rules prior to 2018. We'll see what happens, but it might change earlier than that. But a Roth conversion is you're converting a traditional IRA to a Roth IRA. Now, remember, with the Secure Act, there is still a 10-year rule on a Roth IRA to a non-spouse beneficiary. However, if it is in a Roth, you leave a Roth IRA to a non-spouse beneficiary, it's tax-free. They could literally leave that alone for 10 years and let it grow for 10 years tax-free, and then take it all out
In the
on the
10th
very
year.
last day of
Uh-huh.
the 10th year, and it all be tax-free. So in that situation, mom and dad would have to start doing Roth conversions, and usually it doesn't make sense to do it all at once, do a
Right.
little bit at a time,
Mhm.
because you have to pay taxes when you do a conversion from a traditional IRA to a Roth IRA. But with the Secure Act, we are definitely seeing that. And also with what happened with the coronavirus, we're seeing Roth conversions more and more and more. We talk about them all the time with our clients. There's a lot of moving parts with Roth conversions. So a lot of times we pull in a CPA, we pull in elder law attorneys, and we say, hey, does this make sense in this plan? Because it's very individual. But it's something to consider, it's something to look at.
Yeah, I think that's we spot the issue, and then we say, let the financial advisor and accountant figure out how and when these Roth conversions should actually happen.
Exactly.
But I think it's such an important distinction about the 10-year rule. I think the biggest question is, so do my kids have to pull it out in 10 equal shares over 10 years for a traditional account? Could they take it all in year one? Could they wait until year 10? There isn't any
Yes.
guidance on
Yes.
that.
Yes.
Yeah. So with the Roth, what's great about that is they don't have to worry about it until the last day, like you said, of the 10th year, and they could take it all, and all that growth over that 10-year period is completely tax-free.
It's tax-free.
So
Exactly.
you bite
Yeah.
the tax bullet. up front,
Yeah.
but the potential for growth and savings and that legacy is, I think, tremendous
Yeah.
now under these
We all,
rules.
when we talk about the difference between a traditional IRA and a Roth IRA, we use a farming analogy. Like,
Okay.
would you rather pay tax on the seed or would you rather pay tax on the harvest? Well, most people would say I'd rather pay tax on the seed because I have no idea how wild or large my fields could grow.
Right.
And that is a Roth IRA. You're paying tax up front,
Hmm.
but it's going to grow tax free.
Yeah,
So I
that's a
really
really
like
great
that analogy,
analogy.
right?
Yeah, awesome.
Yeah.
So, as we wrap up, I mentioned the CARES Act earlier, and that was passed just recently in 2020. And that there were lots of different components to the CARES Act, but how it impacted the requirement to take a distribution if a person has reached their required beginning date, either of 70 and a half
Right.
prior to 2019 or 72. What's your guidance on? Well, I guess could you explain the rule and then how you're guiding your clients on whether they should actually be taking their required distribution
Yeah,
this
and
year?
it changed. The rule, as far as from the IRS, they put out guidance numerous times during the year. It changed because I had some people that took out their required minimum distributions in January for 2020,
Sure.
or they're on a systematic withdrawal,
Mm-hmm.
right? They're getting it monthly.
Mm-hmm.
And the rule, basically,
Mm-hmm.
the rule is that they waived the RMD for 2020. You do not have to take out your minimum distribution in the year of 2020. There's essentially is no RMD. You can still take a withdrawal. You could still take your requirement distribution if you need the money to live on, right?
Right.
So you can still do that. But you're not required to take it out. So a lot of the questions involved, hey, I already took it out. Can I put it back in?
Mm-hmm.
Right. And this is what changed. And I think they finalized it and said, okay, if you had taken out a required minimum distribution from January
Mm-hmm.
all the way through to August 31st,
Mm-hmm.
you could put it back in. So the new rule is August 31st. That could change again. We know how things
Sure.
happen, but you could put that back in. But my guidance, especially since the market dropped, and usually you don't want to take out a minimum distribution because you have to sell assets and you're selling at a low price. If you don't need the money,
Mm-hmm.
don't take out the minimum distribution. And of course, many clients listen to that advice. They did not take it out in March or in April. And of course, the market did rebound.
Mm-hmm.
Markets, they usually do.
Mm-hmm.
We can't predict it, but they
Mm-hmm.
usually rebound. And they're much better off because they did not have to sell those assets at that low price back in March or April or, even June.
Gotcha. So as we are nearing the end of a calendar year, and I guess the advice to any listener would be talk to your advisor about
Exactly.
whether or not to take the required minimum distribution under the CARES Act in 2020 or not.
Right.
Yeah.
Right. Exactly.
Okay. Awesome. Well, Jeff, you have been awesome. Thank you for your
Thanks for
guidance.
having me.
And yeah, it's been fun. So hopefully we'll have you back
Okay.
sometime.
Sounds great.
All right.
All right.
Awesome.
Thank you.
Thank you.
All right, two other strategies,
Yeah.
right? Two other strategies. So a disclaim strategy, and I've used this a couple times this year. As long as you have a contingent beneficiary listed on the account, the primary beneficiary can disclaim all or a portion of the inheritance. And I use an example like, let's say a high net worth individual, let's say mom and dad, and there's a daughter, right? $2 million IRA. Dad passes away.
Mm-hmm.
Okay. He can leave the 2 million to mom, primary beneficiary. And let's say the daughter is listed as the contingent beneficiary. Mom could disclaim a portion of that $2 million. She can say, I'm going to disclaim $1 million of it and leave it to the contingent beneficiary, their daughter. Their daughter can then has a 10-year rule on that $1 million. Now, let's say mom passes away 10 years later. Daughter is named as the primary beneficiary on that account. She has a new 10-year schedule on that second $1 million. So essentially stretched it out for 20 years.
Right.
So we've seen that strategy a few times. And then, of course, life insurance. I can't tell you how many times I've had clients say, Jeff, I don't need my minimum distribution. I don't want it. The government's making me take it. What can I do with it? And you could leverage that. You could put that into a life insurance policy. Life insurance death benefits are tax-free. And if you have a large IRA and you don't need the money and you are legacy inclined, you can create a life insurance policy, and that life insurance can pay the taxes on the IRA.
So smart. Yeah.
So
That's awesome.
just a few things.
Yeah. Great.
Okay.
Thanks for being with us today on Off the Clock. If you'd like to learn more about us, visit our website at pwwlaw.com. Of course, you can contact us directly by calling 302-628-4140 or emailing info@pwwlaw.com. We're here to help you plan today to protect your families tomorrow. See you next time. Anything discussed on Off the Clock is for general informational purposes only and is not intended to create an attorney client relationship. To obtain the most reliable guidance, listeners are encouraged to seek personalized advice from qualified professionals.